Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KRAFT HEINZ CO quarterly report. The KRAFT HEINZ company offers a diverse range of products and services across various industries. Their business portfolio includes food and beverage manufacturing product sales through, plus own sales organizations, plus independent brokers, agents and distributors, plus chain, wholesale, cooperative, and independent grocery accounts, plus convenience value, and club stores, plus pharmacies and drug stores, plus mass merchants, plus food service distributors, plus institutional customers, hotels, restaurants, bakeries, hospitals, etc., e-commerce platforms and retailers. Their product offerings span multiple categories, including condiments and sauces, cheese and dairy products, meals, meats, refreshment, beverages, coffee, other grocery products. The decline of KRAFT HEINZ Co.'s stock price over the past year can be attributed to several key factors. A significant contributor was the company's disappointing earnings reports in 2025, particularly the Q4 2024 report, where sales fell short of analyst estimates due to weak consumer behavior and declining Lunchables sales. This trend continued throughout the year, with each subsequent quarterly report showing decreased revenue and profitability. Additionally, KRAFT HEINZ faced analyst downgrades and price target cuts from various firms such as Deutsche Bank Aktiengesellschaft and Sanford C. Bernstein. These actions reflected concerns over competitive pressures, international market challenges, and persistent top-line weaknesses. The company's reliance on legacy brands and ongoing inflationary pressures also weighed heavily on its stock performance. As KRAFT HEINZ continues to grapple with these industry headwinds, it is likely that the stock price will remain under pressure until the company can demonstrate a turnaround in sales and profitability. The primary drivers of revenue growth or decline are multifaceted and varied across different regions and time periods. In terms of decline, unfavorable volume/mix in North America and international developed markets, higher input costs due to inflationary pressures and tariff impacts, and reduced future year revenue growth assumptions were key contributors. Conversely, revenue growth was driven by higher pricing and favorable volume/mix in emerging markets, as well as increased sales to non-guarantor subsidiaries. These factors highlight the complexities of revenue performance and the need for nuanced analysis to understand the underlying drivers of change. Net income and profit margins. A shift from loss to profit. The company's net income underwent a significant transformation between Q3 2024 and Q3 2025. Initially, the company reported a loss of -$290 million in Q3 2024, but surprisingly turned into a profit of $615 million in Q3 2025. However, this improvement was short-lived, as the net income plummeted to a loss of $6,496 million in 2025. Profit margins also experienced a decline during this period. The gross profit margin decreased from 34.2% in Q3 2024 to 32.1% in Q3 2025, while operating income/loss margin dropped from 0.6% to -7.8%. Adjusted operating income as a percentage of net sales also declined from 15.3% to 14.5%. Several factors contributed to these changes. Goodwill impairment losses and higher intercompany royalty expenses in continental Europe, along with negative macroeconomic factors in LATAM, were significant contributors. Inflationary pressures, unfavorable volume/mix, increased SG&A expenses, and foreign currency exchange rates also played a role. The company's shift from loss to profit in Q3 2025 was likely an anomaly, given the subsequent massive decline in net income. The underlying issues of goodwill impairment losses, intercompany royalty expenses, and macroeconomic factors suggest that the company still faces significant challenges. The company's financial performance indicates a strong ability to generate cash from its core operations. With an operating cash flow of $2,114 on September 27, 2025, and a net positive operating cash flow of $3.1 billion for the 9 months ended that date, it is clear that the company is generating significant amounts of cash from its businesses. This positive trend is further supported by the statement that the company has sufficient cash generated by its businesses and access to debt capital markets, allowing it to maintain a strong financial position. The company's debt level and interest expenses have undergone significant changes over the past year. The long-term debt has increased by approximately $1.3 billion, rising from $19.9 billion to $21.2 billion. This increase is attributed to the issuance of new notes and fluctuations in foreign currency exchange rates. Consequently, the company's interest expenses have also risen, with a notable increase of $40 million in Q3 2025 compared to the same period in 2024. The year-to-date interest expense for 2025 has reached $709 million, a $24 million increase from the previous year. These changes suggest that the company is shouldering higher financial burdens due to its increased debt level and associated interest expenses. The financial performance of various segments and regions in the company's latest summary reveals mixed results. In North America, net income was $615 million for the 3 months ended September 27, 2025, but a net loss of -$6,497 million for the 9 months ended. Despite experiencing inflationary pressures due to tariffs and trade policy actions, measures were taken to mitigate their impact. In contrast, emerging markets, comprising West and East emerging markets and Asia emerging markets, saw an increase in net sales in both 2025 and organic net sales compared to 2024. This is a notable improvement from the previous year. However, Europe and Pacific Developed Markets, EPDM, did not provide specific financial data for the 3 months ended September 27, 2025. The segment did report selling its infant and specialty food business in Italy. Asia Emerging Markets, AEM, had no specific information provided on page 43, but was included as part of the Emerging Markets segment that saw an increase in net sales. Overall, North America struggled with a significant net loss for the 9 months ended, while emerging markets showed improvement. Management's outlook and strategy. The company is undergoing significant changes with its planned separation into 2 independent companies by mid-2026. This restructuring will allow each entity to focus on specific markets and customers, driving growth through strategic capital allocation and operational efficiency. The company aims to increase revenue in key product categories, expand market share, and introduce new products in faster-growing segments. Management expects future growth to be driven by higher pricing, reduced manufacturing costs, and favorable volume/mix. To achieve this, the company will invest approximately $950 million in 2025 on maintenance projects, technology upgrades, and capital investments focused on generating growth. With sufficient liquidity and a commercial paper program, management is confident in its ability to meet working capital needs. However, management acknowledges potential risks associated with the separation, including material adverse effects on the business or financial condition. To mitigate these risks, the company uses non-GAAP financial measures for consistent performance comparison. Overall, management's strategy focuses on driving growth through strategic restructuring and targeted investments. The company has made several strategic moves through acquisitions and divestitures. Key acquisitions include the Italy infant transaction, which is further detailed on pages 22 and 45 of the report. In terms of divestitures, the company has sold its infant and specialty food business in Italy within the International Developed Markets segment, page 14. Additionally, it closed transactions in Russia, 1Q 2024, Papua New Guinea, 1Q 2024, and a business associated with the Italy infant transaction in the 3rd quarter of 2025, page 45. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In the recent financial period, it paid out $1.4 billion in dividends to its investors. Additionally, the company took steps to boost shareholder value by purchasing 13.5 million shares during the same period. That concludes the financial summary for KRAFT HEINZ CO. Feel free to comment below, and I will be happy to answer them when possible.